Friends, how are you? Igor Pechkovsky is here with Windermere Bellevue Commons, your trusted real estate advisor on the East Side, Seattle metro areas. Today I have two videos to make. I've been procrastinating on those videos for way too long, so no mumbling today, straight to the point, nice, sweet, and easy. Video number one will go through numbers. We'll tell you exactly what's going on. For this video I'm making right now, I have a one special slide for you right after we digest of what had happened over the last months. And video number two will make a few quick predictions. So let's go. Please subscribe, please like, please share, and let's make it nice, quick, and clean. All right. So friends, if you're curious at what the market is today, you might be consider buying a property or not. This is the info for you. Let's go into the east side. Let's start with the inventory. 2.7 months of inventory. It had decreased months over months. It's almost a balanced market. 2.7 months means that if there is no new inventory coming on the market, there is enough inventory for 2.7 of a months. If you look last year, check that out. Starting 2018, 19, 20, 21, inventory was decreasing like crazy. So we were, in 18 we were at 2.4, and in 21 we were 0.2 a month. Miserable numbers. That would, very low interest rates at 3%, plus very low inventory of 0.2 of a month. This is how our market skyrocketed to the median price of being 1.7, and today the inventory is back up to the levels of 2018. 2.7 months. It's a balanced market. This is what buyers wanted, and they're getting more inventory right now, which is great for buyers. So that's where that inventory figure is. So now let's talk about the median price. The median price is still hanging out right around $1.3 million. So for 3 months straight, last 3 months, we were at 135. Now we're at 1316. It's a little bit below, still in that 1.3 million range that I told you, like during this summer, this is where it could be. So that percentage, -8, today we're already -25% from the peak of the market. So we dropped a quarter in equity because, this is what 3% interest rates plus that inventory, this is where the price went. Now we're 25% of equity decrease. So this -8 will keep on growing months over months as the beginning of 22. This is where the spike of equity went. And today we'll be comparing the next beginning of 23 to beginning of 22, and you'll see a big decrease. But also, if you compare the median price to the 2020, look at this. Like, it was going year 15, 16, 17, 18, 19. We were just slowly growing, and all of a sudden, like after the 2021, 22, boom, we had this huge post-COVID increase in prices. And if you go back to 2011, 20, like we still 24% higher than what we were back then. So I think even that the prices are still at 1.3, 1.6, it's not at where it was at the peak, but it's still pretty damn good. So that's just what I'm gonna leave you at that. This is all I wanted to say on the median price. Look at graphs yourself, and let's go and some other stuff. So as you could see, year-to-year comparison, last year in November we had 68% of homes been selling over asking. Today it's only 10. We still have 10 sell over asking. That's what I always say. First of all, November, December slower in any season, but the best properties, those properties that buyers will look for, they still could get some 2% over list price, which is really good. The rest is staying relatively stable. 26% of them sold below, so there is a little bit more of negotiation room, and that's what buyers would want to, right? Like that's That's what people couldn't even dream of back in March and April, and that's what the market is. So with that being said, let's go to Seattle, let's go to Snohomish County, bombard through these numbers, and go to my special slide for you. Seattle, my friends. Seattle does not keep surprising me. So inventory is just very stable, 2 months, exactly what it was last months. As you could see through the graphs, where it was again, 2018, we were at 2 months. Then the inventory been decreasing last year, very low. Today at 2 months. Median price right on 900,000. Like we're still up 6% year over year. Like Seattle is doing remarkably well, still up year over year at these interest rates that we had. Same thing on 15% of homes still over asking, and the rest looks very much stable. You could see the graph comparing year over year, months over months, going into December. I think Seattle is doing remarkably well. It's obviously slower, but it also still up with all of the increases we had. So that's Seattle. Let's look into Snohomish County. Snohomish is relatively doing as good as Seattle. So inventory just under 2 months. It's heading into the balanced market. If you could see also 2013 and 2014 inventories were at 2.5, then started going down. 2018 at 1.8, and now we're at 1.9 months of inventory. So it's also kind of interesting to go back and not just compare year over year, but to look, through historic figures. Median price right on the money, 1% up year over year, right around 700,000. So it didn't decrease yet, even in this interest rates. It's doing remarkably, very, very well. And that's what I tell you, even Bellevue, because Bellevue went so high so fast, it's below year over year. But if you look and compare to 2020, like it's still up 24%. And I don't think it will go down another 25% as it did from the peak. But I'll tell you about my predictions in the next video. So Snohomish County over asking, 12% of homes still sell over asking. That's the rest of it. The average days in market, about 17 days. Like that's a market that still moves very, very, very well. With that being said, I got a special slide for you coming up next. Okay, my friends, those are the numbers. The market is very, I could say, stalemate. That's what the market is. It's very stable. Yes, the east side went down a little bit. Seattle, same price as last month. Snohomish County, overall the same as the last months. Bellevue, slightly below, but those are not decreases of a lot of money. 150,000 a month. It's a decrease of like 35,000 a month. Like very seasonal as well, is doing just fine. With that being said, something that I want to show you right here. This could be 2 slides, but we packaged it in one. So when we were talking about last year and interest rates being at 3%, let's start with the interest rates. The way it was, I know that that's the last thing that people remember, 3%. But if you look historically, and especially I have a lot of older clients too, like when they've been buying their homes for the first time, the average interest rate since 1971 is 7.76%. Think about it. Let me repeat it. Look at this slide. Average interest rate since 1971 was 7.76%. I know we got used to 5% interest rates, to 4, to even 3% interest rates, but those are abnormal interest rates. I don't think that personally they should be at 7, but they're definitely not going to be at 3% anytime soon. So if ever, 7.7% interest rates, that's the average. Just remember that. So of course the interest rate dictates the price, and we'll talk about it in predictions. But if you look at it in the perspective, again, 7.7 as the average, and right now we're just a little bit above 6, our market is holding on very, very well, even when it's been at 7, and where it is while being at 6. but also the historical median price equity investment calculation. I found that one being very, very interesting. Remember, you're putting your down payment down, right? So when you buy a home for $1 million, you do not usually put $1 million in cash. You only put 20%. Some people put even less, but on average 20% down payment. So this is the national data, which is very interesting. So right in the middle, you have the prices, right? So, and they highlighted, we don't go to 2013 to 22. Let's just look in 2003 to 2012. Right after the recession, the worst housing recession ever. So the homes in this decade started from 171 to 238. So on the investment to buy that home of 20%, $34,000, the gain still would be $67,000. So if you just look your return on an investment, which is just down payment, not the whole amount that you leverage, but just a down payment on an annual basis, after the worst recession possible we had for real estate, which is not going to be this time, you have still almost 20% return year over year. If you don't understand anything I just said, just pause this video, look at this slide and read it so I don't mumble. But 2013 to 2020 on the investment of 20%, even that the prices went up, you did 40% of a return year over year on the money that you invested. And there are years prior to the last 2 decades, but I still found it pretty interesting. After recession, after 2008, even with that, real estate still did 20% year over year on the money that you invested in it. So I'll leave you with that. Let me go into my next video, which would be predictions, and tell you what I think the next year will look like. This was Igor Pechkovsky, Windermere Bellevue Commons. Thank you for watching.